Here we're going to talk about leisure service financial management related to tourism and commercial recreation. Tourism, in general, is the world's third largest industry. It's a key economic generator for many communities and regions throughout the world. Tourism is comprised of corporations, businesses, and organizations with the common goal of generating financial and economic benefits for the owners. It's an important part of the community leisure service inventory as well as the local economy. Something to remember is tourism enterprises are not public social services. Their contributions to the economic well-being of a community are significant, and they do likely have a positive social impact, but they are not considered part of the public social service. Tourism organizations operate in the public, private nonprofit, and commercial sectors. Let's take a look at different tourism organizations across these sectors. For example, in the public sector, you have state or city tourism departments with revenue sources primarily being taxes, and they generate tax revenue through tourism. If we look at the private non-for-profit sector, we're looking at destination marketing organizations with sources of revenues being grants, earned income, donations, and tax transfers. In general, we look at this as far as a financial measure of success, the health of the industry, and sales statistics. And finally, we look at the commercial sector. Example here would be attractions, hotels, transportations, and so forth. Their sources of revenues are earned income through investment, sales, and so forth. We measure their success through liquidity, solvency, and profit. If we look at the financial objectives of the tourism sector, the goal is creating added value to the economy. The appropriate accounting methods and investment activities are related to the specific organization or business. Decisions to build facilities or services are viewed as investment decisions, and the focus is on a return on investment. When we look at debt and inventory management, we're going to look at the issues of liquidity and solvency. Liquidity refers to the corporation's ability to meet its short-term financial obligations. Solvency refers to the corporation's ability to meet its long-term financial obligations. So we're looking at short-term being bills and so forth, and long-term being able to return profits and stuff like that. When we look at account management in tourism, we need to understand that there are unique industries for the tourism industry. Accounts are frequently temporary, and funds may be submitted in advance of services received. There are also issues of international fund transfers for those sectors. Let's look at unique issues for tourism. Tourism services are notoriously susceptible to differential pricing strategies. So many different prices may be applied to a service that differs in no substantial way between consumers or production or delivery costs. So we have to make sure we understand why there are prices put in place for the way they are and how they are. In general, when we do reporting, it's common for sales and expenditures to be predictable and steady. In general, in the tourism and hospitality industry, this is mostly accurate. Performance evaluation in tourism is the ultimate evaluation. The amount of profit generated is often the core to this. It's with respect to the amount of investment made to the profit generated. We can look at ROI, return on investment. In the lodging area specifically, we look at a performance evaluation called the revenue per available room. This is an important evaluation metric and criteria for that industry. The revenue per available room measures how effectively the resort or hotel fills rooms during low-rate off-season, as well as during the high-rate peak season. Let's compare public, nonprofit, and commercial enterprises related to different areas of contrast. The first one would be ownership, the public being governmental, the nonprofit being the private organization, and commercial being a private corporation or individual. The legal authority is usually enabling legislations in the public, enabling legislation or designation of a tax status for nonprofit, and incorporation through the commercial sector. The different mandates are serving social welfare and commonwealth needs of all citizens for the public, serve specific social welfare needs or leisure interests of a specific population for the nonprofit, and to realize return on investment through service to the most profitable market for the commercial entities. When we look at source of funds for the public, we're looking at taxes, grants, and donations. For the nonprofit, we're looking at grants, memberships, donations, and sometimes earned income. For commercial, we're looking at funds being in the form of investors, creditors, and earned income. Let's look at the market management. For public, the market is limited to geographic or political constituency. For the non-for-profit, the market is defined by a particular or specific need. In the commercial, the market is composed of those who can pay. It's defined by merit. All right, so the success indicators for the public organization is social change. For nonprofit, it's social change and financial viability. And in commercial enterprises, we're looking at profitability, growth, and return on investment. The opportunities or advantages for the public organization are tax exemption, use of volunteers, and bulk purchasing and discounts. For nonprofit, it's also tax exemption, volunteers, and overall public concern. The opportunities for commercial are entrepreneurship, support for eliminating financially unsuccessful products, and so forth. And finally, the challenges. For public, it's public accountability and scrutiny in changing political directions. For nonprofits, it's relative uncertainty, reliance on people giving money and volunteers, limited qualified staff, and inconsistent leadership at times. The challenges for the commercial sector are developing and maintaining different things as far as skills and products. There are benefits to competition and cooperation. Let's look at competition first. Competition usually means there's greater choice for consumers. There's a great attention to high quality service, an increased ability to respond to an increasing demand, and a greater opportunity to focus on specific market segments. The benefits of cooperation can be operational efficiency, building a synergy, and a coordinated approach to deliver sport, tourism, and leisure services into a community. Overall, it's important to remember that the common goal of tourism is generating financial and economic benefits for the local community. It is an important part of the community overall as far as economy and services.